Hi, I'm Mark Draper from Gem Capital, and today's gem is how you can save tax by making a tax-deductible contribution into superannuation, and which basically results in replacing your marginal tax rate with the tax rate of a superannuation fund, which at this point in time is 15%. Let's first have a look at what are the marginal tax rates in Australia. Here they are on your screen now. Key criteria for being eligible to make a tax-deductible superannuation contribution is that generally you've got to be below age 65. There are special rules that apply for those who are over age 65, so it's certainly possible, but you don't even have to be working if you're under 65. The second criteria is that you've got to be an Australian resident for tax purposes, and the third criteria is that you cannot have received a superannuation contribution from an employer, as in the 9% compulsory superannuation. If you have and you've got a very small amount, check your advisor for the ruling on that. Basically how it works is it's as simple as paying money into a superannuation fund, and then that amount of money can come off your taxable income when you do your tax return. It's really as simple as that. The key part of it is that you have to tell your superannuation fund that you're intending to claim a contribution on a particular amount of money. That's crucial, and that has to link up with your tax return. That's the really tricky bit. So let's have a look at an example. Consider someone who's 58 and not working, and they get $60,000 a year from a government superannuation pension. So tax normally on $60,000 is around $11,850. If that person were to contribute $10,000, and I've just used $10,000 because it's easy on mathematics, if they were to contribute $10,000 into a superannuation fund and claim it as a tax deduction, their tax liability drops from $11,850 to $8,850. Of course, there's superannuation tax payable on the $10,000 at 15%, so $1,500 gets added to the $8,830, but it's still $1,500 less tax than they would have paid if they did nothing. So the key aspect here again is that all you're doing is replacing your marginal tax rate with the superannuation tax rate of 15%. So finishing off now, who is this strategy really useful for? The key people that we can think of are self-employed people or anybody who doesn't receive superannuation 9% contributions. And the other area that is generally not widely known are retirees. If you're retired and have income over $37,000, which puts you in the marginal tax rate of 30%, then you might well consider making a tax-deductible superannuation contribution to lower the amount of tax that you pay. This is a complex area. This is just a fly overview of how the thing works. It's not difficult, but it's important you get the right advice with this.